What is going on, everybody? And welcome back to my weekly update. And yes, it's been about 2 weeks since I have made a video. Again, something I talked about over the holidays over the past 2 weeks. There really wasn't a lot going on, although the first week of January has been quite interesting, and we'll kind of get into that. But this video, ultimately, what I do is I do a weekly video providing updates for upcoming events, upcoming earnings to get you prepared for the week ahead. So if that does sound like you're interested in, consider subscribing, as I do provide daily updates as well at Hemi137. I do a voice, and I do a video in the morning to kind of give you the pulse of the market on what's currently going on. Because the market can change and is so dynamic, it's important to know what goes on each and every day. So with that being said, this particular video, we are talking about 2023 and kind of our outlook for 2024. And so I wanted to create this about a week ago, but I figured I would take some time off, a little bit extra time, as there wasn't really much going to happen until earnings. And guess what happens on Friday? Yes, we are coming back into earnings. And so this is kind of what we've been waiting for the past 2 weeks. There's been some volatility, like I stated last week. There's been some selling off, which is interesting going into an earnings cycle. Normally, you pump going into an earnings cycle. And so this is why I always try to give baseline, because baseline is extremely important to know on average what happens compared to what's currently going on. And to see it selling off quite heavily going into an earnings cycle is not a good sign. Now, before we get too much into what is currently going on, let's kind of recap what has happened over 2023. 2023 was expected to have essentially a recession, price in more recession, continuation from 2022. What we did see is we started to see a banking crisis, essentially the loss of SVB in multiple banks on every earnings cycle. And this is what is important. And a lot of this is not in headline news, and they're trying to cover up a lot of this because of that issue, and because of the fact that banks are sitting on $700 billion unrealized losses, the worst since 2008. So the fact that Yellen is jumping on here and saying that we have achieved a soft landing is a big old negative, because that is not the case. And as you can see, kind of jumping ahead of myself here, but there is this article, and shout out to Swordfish for this particular one. But when she was the Federal Reserve board member, when she was in Federal Powell's position, she did say the same thing, essentially saying that we have essentially achieved a soft landing back in 2007, before the great financial crisis. This is something I pointed out with Home Depot. Home Depot is essentially regurgitating a lot of the same articles, same verbiage we have seen back in 2006, 2007, before the great financial crisis. And essentially, we have seen over the earnings. This is why you have to look broader on the earnings, and seeing that there's a massive, massive decline on what is currently going on as far as um, the earnings that they're essentially gathering, right? The profits, and essentially the massive losses that they're gaining over time. But when you silo these earnings to, well, let's just make it to expectations. If they hit expectations, it's a good sign. When you have to see, again, or the overall broad sentiment is that things are in very, very bad shape, and continuing to be very bad shape until rates start getting cut. So again, kind of jumped ahead there, but that again, that article is extremely important. Something I want you to see, that it's a straight taken off one of Yellen's speeches back in February of 2007. So these are things you have to pay attention to, that, again, headline news is not going to put out there, because, again, the algorithms are reading headline news. Again, we've talked about that on the revisions, which is something else I'll get into here in a second as well. So the 2023 also recap was essentially coming in. Again, expectations were extremely low, that we're just going to keep selling off. In 2022, again, we could have potentially hit rock bottom on tech, when there was essentially this big surgence in AI and the huge hype around AI and what it could potentially do to essentially pull us out of any kind of recession and essentially achieve this quote unquote soft landing, which I do believe will help and will actually happen, but it takes time. But again, the market gets ahead of itself, and so it started pricing in all this AI hype, and the market was led by the big seven last year. So you had essentially led by Microsoft, NVIDIA mainly because of the hardware, right? And you have to understand the infrastructure has to be built out first before essentially companies like Apple, Amazon, and then Microsoft obviously can create these essentially um, AI that is strong enough essentially to take over people's jobs. Now, you have to understand that AI is just a tool, but that's not the way it came across, is that I would just start replacing people's jobs, and that's not the case. It can make engineers more proficient at their jobs. It can help with a lot of different things, but it's not going to completely take over the jobs. It's going to take years, and something Elon Musk has talked about multiple times, and something I have a lot of programming experiences myself as well. So, being said, it takes a lot of time for these models to be able to be trained up on these things. And Elon Musk has pointed this out. You have to train these models to be able to do that. And again, we've seen where the current state of the models are a very basic, like fifth grader level at the point. And that's not saying that in 5 to 10 years it won't be able to achieve phenomenal results, and that's what Elon Musk is afraid of. So, but being said, that's what essentially led to AI hype in the beginning of the year. And so every company that mentioned AI in their earnings essentially got a huge boost, and we've seen that across the board. And so that led the rally in 2023. Now, since 2023, we've had rate pauses. We've had rate pauses essentially for, I believe it's the past three monetary policies. And then when our next monetary policy is coming up here in January, which I'm not expecting, is a high probability. Nothing is going to change. There will be no rate cuts in January. Then we got February off. And then in March, there's a strong possibility we could see a rate cut at that point. Now, this is what I'm talking about, is that we are really waiting on that rate cut, because that rate cut is going to price in a recession. Things have to get very bad for the Fed to price in a recession. We've seen what happens, what has to happen in order for the Fed to start cutting rates. And if it doesn't happen, in my opinion, in March, we may have another chance in June. If it doesn't happen then it's not going to happen, because you are right in the middle of also an election year. And on average, election years have been very bullish. And so that's the thing that's concerning, is we do have an election year, but also we are essentially on the precipice of a recession. We are in a recession, and something Kathy Woods has talked about. We've been in a rolling recession in different industries to this period now, and then now we're going to get into this very deep, dark recession because of the current number, essentially the current rates of where they're at and what's currently going on. And again, why I said you have to go a couple layers deep to find these things. A lot of the surface level stuff that you're reading in headlines isn't going to tell you what's really going on. But a lot of people won't do that. And so they'll just go off the headline news and assume that's what it is when it's not, and still have many questions about what's currently going on in the economy. So with that also being said, we have China Evergrande, and we also have Country Garden, two of the biggest real estate holders, or essentially the real estate home loans. They essentially went belly up. Now, Evergrande is something in 2022 that they were essentially they went bankrupt and couldn't make their payments. They delayed it until this year. It was roughly about a year ago, and then they opened up. The stock finally opened up. They didn't want anybody to be selling anything, and opened up like 87% down. And then on the same token, you had Country Garden, which is in the same position. They couldn't make their payments, and now they're delaying them again. So you're seeing this massive crash that was going on in China over the past year, and that they were trying to do quantitative easing because they've killed demand. And we are not far from that. And understand it takes a couple months for that to essentially occur in our environment. And yes, this happens overseas, much like we kind of see how it was going on with the virus as well, and understand that it was a very delayed reaction. It took months for it to hit us. Now, it doesn't really matter what it is, but when it comes to like the economy, it's the same kind of scenario plays out. It will hit China and Europe first, and then months later, we will essentially play out the same scenario again, because you have to understand we're very intertwined when it comes to the global economy, and understand it does affect us, even though, you can say, we don't have a lot of exports or whatever. It does to an extent, but ultimately understand that it's still going to affect us, because they hold a lot of our debt, and people just don't understand, because you're in a debt-based system, it's going to affect us nonetheless. And so with that being said, Evergrande, Country Garden, still very big things to watch over the next year, but we'll see what happens there. Office building prices in the U.S. are down 40% from its peak 2 years ago. Now, Again, the administration has talked about this as well. They've talked about trying to make essentially 15-minute cities in a lot of these corporate buildings because people don't want to come back to work, right? Because of the pandemic and everything going on, people went remote and they don't want to come back. And so now that, people are having to come back to work, essentially they are forcing people to come back to work. People moved away, purchased all these homes because they were saving more money, and then they didn't have to come back in. And now they're requesting that they come back in. And so people are quitting their jobs. And so there's a lot of issues when it comes essentially to um, the sector and those buildings that are essentially unoccupied during this time. And so we're seeing a huge crash, and a lot of people have essentially pointed to the fact that this could be what crashes the market on that particular side. When you're talking about the housing industry, you also again got the corporate side essentially with buildings that are unoccupied and could essentially cause banks to start defaulting because nobody can make that payment because they don't have people there to occupy that space. So again, something that is going to be watched, and I do believe going into this year we're starting to see huge declines as well, and a lot of prices as well. You have to understand when it comes to housing, that scenario is a very, even when like the 2008 crisis, it took a very long time for that to play out. You have to understand that's one of the very last things to really roll over, right? People are sitting on 3%, essentially the quote unquote the golden egg right now when it comes to interest rates. But you have to understand that, people pass away, whatever the case is, people inherit that. They don't want to have the house. They just want the equity in the house. So they sell the home, right? All these things are going to play out. So it does take time for these things to happen. And I ultimately understand that people get bored in a place. They want to move. They want to sell. Obviously, they're not going to do it now, but give it another year or two, people will have to sell and they will have to pay in the new interest rates. They're not going to hold on to the interest rate forever, right? People are naturally like change. It's just the way things are. And so you have to give it time. Yes, this particular year was an ideal year for people not to sell. People are starting to realize interest rates are too high. I don't want to move. Next year, that's going to start diminishing, right? And people are going to want to move. And the year after that. So you have to realize next 2 to 3 years are going to be very different when it comes to housing. And again, prices are high now because of the fact that people just can't afford it, and there's a very limited supply. Ultimately, it comes down to it. There's a very limited supply. When supply starts coming out, because people start losing their jobs, I believe we're going to get in a section, and we'll talk about non-farms and jobs here in a second. But we're going to get to a point to where people are going to start losing their jobs and have to dive into the equity in their homes, and will be forced to sell. And at that point, when there's a lot of supply, those prices are going to come crashing down, and we're seeing that in certain places. And again, there's certain it's not going to be that all across the board. You have to talk about in general across the U.S. That is making some huge declines. And we're talking about big areas like Austin, Texas. When you're talking about like the Phoenix area, California, Florida, right? Like a lot of these big sectors, New York City, right? A lot of these big sectors are already seeing huge hits on housing because it's just too unaffordable. We're at one of the most unaffordable times in history right now. And you have to understand that this is going to make a big difference. And it takes a long time for that to change overall. A lot of these cheaper states that people are moving to and actually boosting up. So you're seeing an increase in a lot of these cheaper states. So people are like, what are you talking about? It's up like 20%. It's true. In cheaper states, it is a lot. You're seeing massive growth because people are moving, right? People don't want to pay the high taxes, the high insurance on a lot of these big cities, right? And then people are moving out of these big cities into these smaller towns because of that fact. And so these are things you have to look at. But you have to understand the general consensus is as we are starting to see a very steady decline year over year, and that is the concern. And once a major supply starts to hit, and that will happen once essentially you start seeing massive layoffs, which I believe this year you'll start seeing massive layoffs at some point this year. The real question would be is how the administration is going to be able to handle that going into an election year. Can they essentially pencil whip it to ultimately look good? And that's what essentially kind of leads us into the non-farms. It's not last non-farms we had 10 out of 11 job reports revised lower. 25% job gains in 2023 revised away. 25%. And about 25, you have to understand the government holds a huge chunk of those job numbers, and understand that that's ultimately that they essentially if you look at this, the part-time jobs up 276,000 versus full-time jobs down 1.5 million in December, right? That's not a good stat. It's essentially, we've talked about this before about a gig economy. People are having to work part-time jobs, that full-time jobs are being hard to come by because of the fact that companies don't want to provide the benefits because it's just too expensive. It is too expensive. Yes, inflation is still very high on specific things, and yes, of course people aren't going to purchase vehicles or anything else, which that's a whole other discussion about vehicles. Vehicle prices are starting to come way down, not your conventional ones that everybody, that are long lasting, like your Toyotas and your Camrys, whatever the case is. But ultimately, your big luxury vehicles are dropping massively and sitting on lots massively because people can't afford them, and people that are just randomly going out, and this is also something else that's going on, is people are in just this FOMO lifestyle that you only live once, and just spend, obviously because our country is doing the same thing. I don't know if this is essentially trying to lead us into CBDCs, but the massive printing that is going on right now is very, very concerning. But also understand that I think our growth rate, our GDP, which is concerning because essentially the interest that we're paying is absolutely absurd. Like we are, it's bigger than our defense budget, right? And so, with that being said, I think with AI can get us to the point to where that would compensate for that. But you have to understand, it will take time for that to play out. Yes, a lot of people say that it's not going to happen. I believe it will happen, but it will take time to play out. I believe essentially leveraging technology innovation can do that, but you have to give it time, and ultimately understand, I don't think we're going to have this massive crash like a lot of people think we are. I do believe we'll have a correction for the recession, but ultimately understand, I think that's why I think we will have a big huge a boom cycle out of this, because it will be led by crypto and AI coming out of this, and that our growth rate will get better. But ultimately understand, again, the massive spending that is going on. Again, I think they're trying to lead a crisis that will essentially force us to have to use CBDCs at some point. And you have to also look that we are barely having a dent into what someone like, say, China has done, right? Their massive printing is makes ours look childish if you want to compare notes, right? So ultimately understand, these are things I've been talking about over the past year, and they're getting worse. But you don't know when exactly that's going to take into account into the market. That's what we're trying to pinpoint. That's why I understand you need to know what your baseline is and go off of that. That's why I'm looking for this. March has a lot of things lining up for March. You got Bitcoin halving, and April 14th, you have essentially the spot ETF, which we should get news this week as well. So be on the lookout for that. If that doesn't get approved, I can see some massive selling from that. So that I think the big hype in crypto that's currently going right now, again, is a, buy the rumors, sell the news kind of thing. So you have to be very careful if that doesn't get approved this week. And so these particular things, if they play out for that March, that's our normal pullback. The question is will we get rate cuts during the same time? If we get rate cuts during the same time, then we would price in a recession. At that point, I would be buying everything on that dip. This is what I've been talking about for about a year. At some point, this is going to pull back, and that would essentially be our final pullback, in my opinion, before we start getting some sort of kind of boom cycle. Again, it's not going to go completely vertical. I don't believe it's going to go completely vertical, but over the coming years, I think we will finally get into a state to where we will gradually start increasing. And then once AI starts taking over, I do believe our GDP can catch up to some of the spending. But again, that's going to have to be dialed down. There's a lot of things that come into that could potentially play out as black swans this year, that could lead, again, once the fear comes in, how much fear can keep getting fed in. Again, you need new fear to come in. Right now, we're seeing a lot of that, as a lot of people can't essentially pay for particular things. You have to keep that in mind. These are all different things that are playing huge into what's currently going on. And so this year is that year that's going on. And you have to also understand the Epstein list that's going out, right? There's a lot of new news that is coming out that's being exposed. This is essentially the year of exposure, essentially chopping back, right? It's an election year. It's going to be a big year. You're going to see a lot of headline news this year, so you have to be prepared for that, and you have to be prepared for a lot of manipulation, just trying to get to the election to happen. And so again, I wouldn't be surprised if on that normal pullback cycle, if we don't get rate cuts, Right there was going from six. They went from six essentially rate cuts down to three now. Last year we're supposed to have four. By the end of the year, we got absolutely zero. So you can't go off of these forward guidances, right? You have to go off of when is it actually scheduled, what is currently going on, and as of right now, we have January and March. Right now, by the time March hits, we're going to essentially have all our earnings from all the industry leaders about done then, and something on a normal cycle like I've talked about. Once earnings are essentially reported, like 3 to 4 weeks after that, stock will start pulling back, essentially waiting for the next earnings cycle. So with that being said, that is our opportunity. That's what we are aiming for. Now if we price in a rate cut at the same time, then we press in a recession. Then we can start looking at what's going on. But again, you can't go too far ahead of yourself because you don't know what news is going to be dropping along that time, right? Like, again, we're going to be watching banks. We're going to be looking to see if there's any more banks that go under. Again, this banking crisis is still going on. They closed like 60 some bank branches. They are reducing risk. All the things that I've been talking about are reducing risk because things are in a very, very bad state. They are not in a good state, and the market hasn't priced in a recession yet. So you could look for that again. An average correction is about 42%, right? And last year we saw roughly, not last year, but more so the year after that, we saw in 2022, we saw roughly like a 27, I believe it was around 27% correction. So these are things you have to keep in mind coming into this year. So we'll see what happens there. Upcoming week. Now, let's start talking about 2024. I have started kind of touching on some of those things. This upcoming week, we do have core and we do have PPI coming out. This isn't core PPI. We have PPI coming out on Friday. So again, understand the core CPI is pushed on a Thursday. It was normally on a Wednesday. I've talked about them strategically moving stuff around. Again, bank earnings are on a Friday in case they get bad, because they know eventually at some point they will get bad. Let's report them on a Friday, take it into the weekend, and deal with it like they did when SVB went down. They took it into the weekend. They said everything was fine and dandy. They almost lost another bank. Again, they've been backstopping these banks, and this backstop essentially, let's put a couple $1 billion in there, and we can leverage the hell out of that. And so they've essentially been covering all these other banks with the same tool they've been using. They just repackage it as all it is, and essentially helping these banks. And understand that a lot of these CEOs pay themselves out of bonuses and stuff at the end of the year out of this new package and stuff, right? So these are all the things that are going on. There's so much corruption going on. It's ridiculous. But anyway, that's not what we're talking about here. So core CPI, again, we got that on Thursday. Again, that's going to be important. The biggest thing watching here is we don't want inflation to start kicking back up. The last thing we want is to start cutting rates and demand start screaming back. That is concerning. And you have to understand, a lot of these people that are trying to purchase homes, even right now, they are taking loans from their family. They are not taking loans from the banks. So, and again, not everybody has that luxury to be able to do that. So you have to be very careful, but that's what a lot of people are doing. This is where the demand you're still seeing that's coming in is from that. But if more people start getting laid off, Google is a good one to point out here is, they essentially rode all last year with, we didn't fire anybody during the whole tech sell-off, but now they're talking about laying off 30,000 people, right? This is how bad things are getting. Google, of all people, were like, no, we essentially pride ourselves in the fact that with all these tech layoffs, we are still holding strong. But they can only do that for so long. Things are getting bad. And I will believe we will hit a 2% target on essentially our inflation rate. But you have to understand that it can go negative, right? I think essentially the Fed I believe, and what Kathy Woods is saying in her statement as well, that that it's so high at this point that once it's still very lagging effect. You have to understand it takes months for these these loans to mature, and then they have to purchase these loans, and for this whole thing to play out, that there's still a very lagging effect, in that when this does take place, there's going to be a screaming amount of massive layoffs that are occurring all at one time, and it's just going to sideswipe everybody out of the blue is what's going to occur. And that's why the administration, the Fed, they know these things, and that's why they try to strategically place these things, because they know at some point it will give. Now, can they continue to kick this can till after election? They will try to. This is something you have to watch. And I said last year, if it doesn't happen this year, right, I was really aiming towards July. If it didn't happen by July, I was very uncertain. I was like, if October, and it pulled back pretty far, I think in October, it went back down to the 4,200 level, the 4,100 level, and it kicked right back up, because that's when we started cutting, or that's when we started to pause and people got excited. And something I talked about, when we get into an official pause, it takes about 3 months before we see our first cut. And so at that 3 month window, you will get a rally. And we saw a crazy rally towards the back half of the year, roughly around October. And this is what saved the market from dropping that 4,100. Now, the question is, as soon as we come into this year, we start selling off. When is that interest rate cut going to come? I believe January is too soon. I believe March is a perfect time. That is the normal time for a pullback. If we get rate cuts announced in March, right after earnings, and we see how crappy the earnings are, that could be the point where we start really pricing in a recession. Now, I do agree with Kathy at the same point too. There's been a lot of rolling recessions. There's been some horrible, horrible numbers reported out there, and people are doing horribly bad. And again, inflation is still very rampant on a lot of the everyday items that you have to purchase. Again, you're not going to see inflation across the board anymore, because of the fact that people can't afford other things. They're just, again, trying to pay for the basic necessities, and understand that that's where inflation is still lingering. In services is a big one of those that takes a very long time for inflation to come down. And so even though we a rate cut, you can also assume the fact that they will raise it back up. If we're going to be playing this game for many years down the road. And so you have to be prepared for that. But when it comes to the market, again, my ultimate cue is just trying to price in the recession. I believe once we get that first rate cut, that's when we price it in. At that point, then we will take strong positions going in and moving forward, and then I will be bullish. Then I will believe in a bullish market at points. I don't believe it just going pure vertical again, but I do believe that it could be led by AI in crypto. I strongly believe that, and so that's the sectors I am focusing on moving into what will be the bullish market coming up. But again, there's a lot of things that have to play out. This is why we're going off the baseline. So those numbers will be important, and we'll see what happens there. Again, monetary policy, we have our core inflation is this week. Monetary policy is until the 31st. Then we have that big gap between that and March 20th. And then we have our other core inflation, which is in February 13th. And then upcoming earnings this Friday. JPM, Bank of America, Wells, again, all the big banks reporting on Friday. Something I've always talked about, if something bad occurs, they can take it into the weekend and address it like everything is fine and dandy. They're just soft landing. You're going to continue to hear Yellen saying everything is fine, that we've defeated inflation, everything is great. You will continue to hear these things, because these are the same things that play out every cycle. This is the same song and dance. They don't want people to panic. People are in panic. There's chaos. You can't control chaos. So with that being said, watch list this week. Some big differences. Like I've said, the biggest difference when you start getting the earnings, again, you're seeing the bigger differences. When it's economy based, you see a big impact on SPX, which we're not really seeing. SPX is around average. Tesla earnings, I believe, is next week. So you're not seeing a big jump. You'll see that jump even more next week. Boeing is coming down because there was some bad news that came out about Boeing. So that might start selling off this week as well, which will add, because Boeing plays a big part in value. And value is one of the big industries that have been holding up the market this back half of the year. So, and they got Chase, which is they priced essentially doubled what they expect. And you don't typically see a huge double like this in JPM. That should be concerning. The fact that JPM is doubled, because it doesn't, going into earnings statement, I don't think I've ever seen it double like this. I've seen it maybe going up a point or two, but the fact that it's doubled is very concerning, right? Because they report on Friday. So these are things, these are key indicators that I report all the time that you need to be focusing on. JPM is doubling essentially their expected move. They're expecting a big move to happen on Friday. So whatever numbers come out, it's 2024. It's a new year. We're after we're after the holidays, right? We're gonna get the true numbers. This is one thing to look forward to in this earnings cycle, is we're gonna get the true numbers, what's actually going on, all this Black Friday sales and all this this misleading headline information. Let's end the year on a happy note, right? And then you come into 2024 and you realize things were really, really bad. That's about ready what we're going to see. And so I think that this is why, if it's going to happen, it's going to happen in March. Once after all these industry leaders report, we will get our true numbers. We will understand what's really going on. It might be more layoffs, might be more bank losses on Friday, more so probably next week. We'll probably hear more about bank losses if that does come out. All throughout this earnings cycle, they'll be washed in their advanced talks. You don't really hear about it until they've already been essentially absorbed by some other bank, is what you're going to see. And yes, we will continue to watch more banks go under. The rates are still high. Nothing has changed. Until the rates change, you will continue to see the same song and dance of things getting destroyed and absolutely obliterated. And understand that the Fed want this to happen. They need demand to come down. And they will continue, even though they cut, they'll still be very high. They're not going to just cut everything back down to zero. Again, I think if they overshoot it, which I do believe they have done, if it gets to a point to where all of a sudden we're seeing massive layoffs, and we're seeing these huge changes, then at that point, that is going to be a huge problem, right? And then maybe they would start cutting rates back down to, maybe all the way back down to 3, maybe. I think you'd be really lucky to see anything like you did 2 years ago for a very, very long time. But with that being said, you're going to get a huge correction on interest rates only if they're going to slowly increment it, obviously, because they don't want demand to come soaring back and start shooting inflation back up. So these are things you have to watch. Everything is based off of what happens with the interest rates. And this is why interest rate decisions have a huge impact on what's going to happen over the next couple of years. But again, that first cut is when you price in a recession. So things have to be bad for that first cut to happen. So with that being said, I am finally done with this. That is quite a bit going on there. But with that also being said, I'm probably going to break this up into 2 different segments. So check into the next video. I'm going to continue this video, but I'll make this 2 separate videos to kind of go over the charts for the new year.